I hope you can hear me now. Great, excellent. Thank you very much. So I'll begin again. Bismillah ar-Rahman ar-Rahim. Thank you very much for joining in such a big number. This session on IFRSs and IASs is currently being run across Pakistan, across the entire Middle East, Sri Lanka, and Bangladesh. And I welcome all of you. It seems that there's a lot of interest in updating knowledge, updating skills, knowing about IFRSs, and that is evident from the session that we are currently running by the numbers that are currently listening to this session. For those people who haven't used the webinar before, I will take a couple of minutes only to explain how this session will be run. Number one, you should be able to see the presenter on the screen, Mr. Abu Bakr. He's the presenter. He'll introduce himself as well. You should be able to see the slides also. And at the same time, from time to time, for practical illustrations, Mr. Abu Bakr is going to use digital medium, electronic pen, etc. to demonstrate various practical examples to you. We've made slight modification to the way we used to keep a log of participants. Although this software is very, very capable, it keeps a complete log of the entire event. So all the questions that you ask, all the answers that are presented, the proceedings of the session, they're all recorded. Who joined when, left when, what was the level of interest, etc. So all this information is available to the administrators. Normally what we do is that looking at the interest level and the time that the person has spent on the webinar, we give CPD certificates reflecting the right amount of time that the person has spent on the webinar. This time we've included one new feature, and that is pop questions. So during this complete session, about 7 pop questions will be asked, right? So at different points in time during the session, these questions will appear on the screen. The presenter will announce that the pop questions are up, and you will be, and these are multiple choice questions, very, very simple, and you should be able to select the right option from the options being displayed. Again, your answers will be recorded. And therefore, looking at the answers and those people who answer all the questions, the certificates, the CPD certificates will then be sent out accordingly to all the participants. About questions and answers, once again, for those individuals who have not used this webinar feature before, if you look at your control panel, there is a questions dialog box available. Right? All you have to do is expand the questions dialog box, type in your question, and send it to me. I am moderating the session, and I should be able to put up the question to the presenter whenever there's a question and answer break. So in between the session, we will take appropriate breaks. Yes. Right? And during those breaks, we will then answer the questions that have been put up. Please keep the questions relevant. Please try to keep the questions related to the session that has already been conducted, right? And therefore, we can focus more on the content that has to be delivered, and we don't have to spend too much time on answering each and every individual question. Although we will still try to answer as many questions as possible, but of course I'm going to leave out duplications. I'm going to leave out some questions which are not relevant to the content that has been taught. Yes. Okay. Last but not the least, I think you should all enjoy the session very much. Keep it interactive. Your number of questions are going to indicate to us how did you like the session, and that is going to define our way forward on how many more sessions and on what topics should be conducted across this region. So good luck to all of you. Enjoy the session, and I now hand it over to Mr. Abu Bakr, who will take it on from here and run the session. Thank you very much.
Good evening. Can you hear me now? I hope you should be able to hear me now. Okay. So let me introduce. My name is Muhammad Abu Bakr. I am partner of Baker Tilly Mahmood Idris Kamar, Chartered Accountants. This is basically world number 8 chartered accountancy firm. And I have diversified post-qualification experience of about 13 years of performing leading roles in the practice areas of audit and assurance, business advisory, not only in Pakistan but also in the Republic of Yemen and Republic of Mauritius. I have delivered trainings to the professionals, including partners of 2 renowned firms of Mauritius, and I am a visiting lecturer at CFE Group of Colleges Pakistan and BSP Associate Mauritius in financial reporting, audit and assurance services, corporate governance, risk and control. I was also responsible for training of audit staff on IFRS while working with Ernst & Young as manager. So the contents are, we shall cover the following areas in multiple sessions. Number 1, IFRS 15. Second, financial instruments, International Financial Reporting Standard 9 and International Accounting Standard 32. Then at the end, International Accounting Standard 12. In this first session, we shall cover International Financial Reporting Standard 15 and a part of financial instruments. The remaining areas will be covered in the coming session. In order to get most benefit out of this session, so there are certain things which need to be taken care of. Have a notebook and pen ready, but do not try to write everything because these slides will be sent to you by ACCA. The recording of this session will also be made available after some days. Be attentive. So toffees and chocolates can help you in this regard because so many concepts are tightly linked with each other. So a point may not be understandable if the related earlier concept is not appreciated. Members and other professionals sitting in groups should not start commenting until the session ends. Otherwise, this will impair the hearing of others in the group. You can ask questions. All questions cannot be answered, but we shall try to answer as many questions as possible. Since we shall be covering the concept substantially, but still may not be 100%, so please be relevant and short in your questions. So let's see what are the contents. First, International Financial Reporting Standard 15. Then, what is the difference between International Accounting Standard 18 and International Financial Reporting Standard 15? There will be a brief discussion on this content because our main purpose is to learn the IFRS 15. Then, impact of International Financial Reporting Standard 15. And at the end of today's session, we will discuss the most impacted industries as a result of issuance of International Financial Reporting Standards 15. International Financial Reporting Standard 15 replaces the following standards and interpretations. IAS 11, construction contracts, IAS 18, revenue, IFRIC 13, customer loyalty programs, IFRIC 15, agreements for the construction of real estate, IFRIC 18, transfer of assets from customers, SIC 31, revenue barter transactions involving advertising services. So these are the standards and interpretations which will be replaced as a result of issuance of IFRS 15. IFRS 15 will apply to contracts with customers except leases within the scope of International Accounting Standard 17, insurance contracts within the scope of IAS 4, financial instruments and other contractual rights and obligations within the scope of IFRS 9, IFRS 10, IFRS 11, IAS 27 or IAS 28. Non-monetary exchanges between entities in the same line of business. So IFRS 15 will not be applicable to the standards or the interpretations listed in this slide. IFRS 15 will be applicable for reporting period beginning on or after January 2000, after 1st January 2017. Earlier application is permitted. So what is the core principle? So just for the information, I'll be using the Word document just to explain a few core concepts. So what is the core principle in this standard? So let's use this board in order to illustrate the core principle. For example, you promise to deliver goods or services, and you delivered at some point in time these goods or services. So now the question is, revenue, when it should be recognized? This is question 1. And the second question is, how much? So promise to deliver goods or services can be given a term so that we'll not have to write it again and again. We'll be naming it performance obligation. Performance, let me use the razor, performance. Performance obligation or PO. What is performance obligation? Promise to deliver goods or services. So when revenue will be recognized? When PO is satisfied. Performance obligation is satisfied. How much? Expected consideration. Expected consideration. So these two are the core principles of International Financial Reporting Standard 15. That when revenue will be recognized, when the performance obligation is satisfied, and how much revenue will be recognized? That is expected consideration. So what 15 says, let's see. The core principle is, an entity shall recognize revenue when or as the entity satisfies a performance obligation. Satisfies a performance obligation by transferring promised goods or services to customers at an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. So one thing is satisfaction of performance obligation. How it will be satisfied? By delivering the goods and the services. And second, revenue will be recognized to the extent that you expect that you will receive that much money. So this is the core principle. So let's expand on this principle. See, for example, you have entered into an agreement. For example, let me select from here the thickness. Okay. So a customer have a contract with you. A customer have a contract with you to supply product A plus product B. Product A plus product B for an amount which is equal to, say, $100,000. So here, what is the performance obligation? Performance obligation is the delivery of product A and product B. This is the performance obligation. This is your promise to deliver these two goods. What is the price? Price is 100,000. Say we have completed product A. When we deliver this product A to the customer, then we need to recognize the revenue of product A. So we need to bifurcate this price into the amount related to product A and the amount related to product B. Say related to product A it is $40,000 and related to product B it is $60,000. So it will make $100,000. So this means when we deliver product A, we will recognize cash or receivable debit $40,000 and revenue credit $40,000. Similarly, when we deliver product B, we will debit cash or receivable by $60,000 and revenue by $60,000. So this is the whole story of the IFRS 15. But people will be surprised. You will be surprised. Is it so simple? Of course, this is that much simple. But of course, we need to go into the detail, into the various aspects of these standards to address the technicalities. In fact, this is the whole standard, whereby what you do, you just have a contract. How many elements are there? We were having a contract. If I just number here the element which I wrote on the top, one was the contract with the customer plus performance obligation. We discussed this in the core principle as well. There was a price, and then as a result what we did? We recognized the revenue. I should write, I think, over here. Recognized the revenue. See, if we just look at it, there is a contract, there is a performance obligation, and we just identified from the top, within a contract, there could be more than one performance obligation. Performance obligation here in this case, performance obligation 1, performance obligation 2. Mean how many distinct goods or services have to be delivered. Here in this case, we will be delivering product A and product B. Both are different and distinct. So within this contract, there are two performance obligations. There are two promises. Promise number 1 to deliver product A against 40,000, and promise number 2 is to deliver product B for 60,000. So this is one thing. Next, if lump sum price is given, then we will have to allocate this price among the performance obligations. So product A is performance obligation 1. see, we'll write it like product A. This is say performance obligation 1. So what we will do, we will allocate this price to this performance obligation. Likewise, if performance obligation 2 is the delivery of product B, similarly, let me change the color so that you can see it better and improve its thickness as well. See, so this is the allocation of the price to the performance obligation 2, which is the promise to deliver product B. And at the end of the day, you recognize revenue. If we just count, this is number 1, this is number 1, this is number 2, identification of performance obligations. This is number 2. And here are 2 elements. One is price, and the second is, number 4 is allocation of that price. Allocation of that price to the performance obligations. Allocation of that price to the performance obligation. This is the 4th. And then the 5th step is recognition of revenue. So I'll repeat. One is the contract. Contract can be written or verbal. It is not necessary that it must be written. Then there should be, of course, some performance obligation. Performance obligation can be single. Maybe there are multiple performance obligations, but we need to segregate them. If there is a one performance obligation, fine. But if there are more, then we'll have to segregate each and every performance obligation. Then there will be a price. So maybe lump sum price is given. If it is like this, then you will have to perform step number 4 to allocate this price to each individual identified performance obligation. And the 5th step is the recognition of the revenue. So this is the whole story about International Financial Reporting Standard, International Financial Reporting Standard 50. So we will term it as, so let's go back to the slides. So all these 5, these are termed as 5-step model for the recognition of revenue. 5-step model for the recognition of revenue. What is the first step? First step is identification of the contract with the customer. Or simple, I can write here, if I can use here pen as well. See, for example, here, let me use pen here. Okay, I can use. So this was the contract which we just identified. Step number 1, there should be a contract. Then step number 2 is, so I'll have to change it to the pointer, or I can do it with, yes. Step number 2 is identification of the separate performance obligations in the contract. So identification of performance obligation. What was the performance obligation? Promise to deliver goods and services. If it is single product, one promise. If it is multiple products, so multiple promises. So you will have to segregate how many performance obligations are there. Then is the step number 3, determine the transaction price. So we name it as price. Then is the step number 4, which says allocation of the transaction price to the separate performance obligation. So this is allocation of price. Allocation of price. And the 5th step is the recognition. Simple. recognize the revenue. Recognize the revenue. So these are the steps. These are the 5 steps basically for the revenue recognition. So we will work through each of these 5 steps in turn. Of course, we will go into the detail. What does the standard mean by contract? What are the meanings of performance obligation? I mean, there could be so many different situations. So how we will identify different performance obligations? The example which I just gave you, that is quite straightforward, but we will look into more complex situation in this area. So we will discuss all these steps one by one. Okay, let me turn off this pointer. I think I can turn off this pointer by using arrow. Okay, fine. So first step number one. Step number one is identification of the contract. Contract can be written or verbal, written or employed. See, in the case of normal retail sale, you go to the local grocery store, there is no written contract between customer and shopkeeper, but there is an oral or implied contract in that transaction. So that's why you recognize that revenue. There is an employed contract. Similarly, contract does not exist. Sorry, I would say contract does not exist if both parties can cancel without penalty. For example, this may apply in a situation where an individual may pledge to future donations where that pledge is not enforceable in law, or purchase order can be cancelled without any penalty. So we need to remember this particular point, that if you can cancel a contract without any penalty, that cannot be termed as a contract under IFRS 15. So 2 examples which I just gave you. If you pledge to any trust that you will be giving this much money next year, so they cannot recognize that donation because pledge is not enforceable in law. Similarly, if you back out, this is not enforceable in law. Similarly, whatever, like another example is purchase orders. Those can be cancelled without any penalty. Another example, an entity, a real estate developer, enters into a contract with a customer for the sale of a building for 1 million. The customer intends to open a restaurant in the building. The building is located in an area where new restaurants face high level of competition and customer has little experience in the retail industry. The customer pays a non-refundable deposit of 50,000 at inception of the contract and enters into a long-term financing agreement with the entity for the remaining 95% of the promised consideration. The financing arrangement is provided on a non-recourse basis, which means that if the customer defaults, the entity can repossess the building, but cannot seek further compensation from the customer. Even if the collateral does not cover the full value of the amount owed, the entity's cost of building is $600,000. The customer obtains the control of the building at the contract inception. See, I'll just summarize it. A company sells a building to a customer and customer pays 50,000, and the total cost of that, total price of that building is 1 million. Customer only pays 50,000 and says 95% will be paid later on. So this is the story so far, and customer wants to build a restaurant in that building. Now the question is, should this organization recognize a revenue of 1 million because it has sold a building? So should it recognize revenue? We are assuming that, and as I said at the start of this example, this is the real estate developer. This is its normal activity that company builds houses and buildings and sell them. Now the question is, should this organization recognize revenue for 1 million whereas it has only received 50,000? See, in assessing whether the contract meets the criteria, the entity concludes that the criteria is not met because it is not probable that the entity will collect the consideration to which it is entitled in exchange for the transfer of the building. If you just look at the slide here, probable collection of consideration. Though you have transferred the building, transferring building, selling building, or delivery of building is a performance obligation. There is a contract, but this contract will not be treated as a contract for the purpose of IFRS 15 because it is not probable. I am highlighting the last point. It is not probable that the collection of consideration is not probable. See why it is not probable? Because the entity observes that the ability and intention to pay may be in doubt because of the following factors. The customer intends to repay the loan from income derived from its restaurant business. Number one. And that business is already in big problem. Second, the customer lacks other income or assets that could be used to repay the loan. And the customer's liability under the loan is limited because if he will not pay the loan, simply he will give the building back to the company. So his liability is limited. What we learned from this example, that even if you have transferred the promised goods or services to the client and you might have received a small amount from the client, but if it is not probable that you will receive the whole consideration, you should not recognize revenue. Similarly, other conditions approved by the parties, the entity can identify each party's rights, the entity can identify the payment terms, have commercial substance. So, identification of the contract with the customer. So all these conditions must be satisfied, except in two situations. I'll be discussing in a while. There are two situations. If though any of those two situations exist, then that will be a contract. Even all these conditions are not being satisfied. Otherwise, except those two conditions, all these conditions must be met in order to declare it as a contract in the terms of IFRS 15. So what are those two conditions? Condition 1 is the entity has no remaining obligations and substantially all the consideration has been received and is not refundable. So if consideration has been received, but the contract criteria is not met, revenue is recognized only when either, so this is number 1, no remaining obligations, this one, no remaining obligation, let me take the help of the pointer, no remaining obligations, okay, use the pen, no remaining obligations, all consideration, substantially all consideration received and not refundable. Second is the contract has been terminated. The contract has been terminated and the consideration received is not refundable. Consideration received is not refundable. If any of these two conditions met, then you can recognize revenue even if the criteria of the contract is not being met. So let's look this situation with the help of an example. Consider a non-refundable 10% deposit paid for the construction and supply of asset, and the supplier cannot recognize 10% deposit received as revenue if it is assessed that there is only performance obligation being the delivery of the constructed asset to the customer. Because in this case, there are remaining obligations required to be completed by the supplier, that is the delivery of constructed asset. So, therefore, condition number one, this condition number one is not met. Similarly, customer credit risk deteriorates as such that the supplier believes would not be able to complete the transaction. We still could not recognize revenue on 10% deposit because 2 is not met. Because 2 has not been met. The contract has not been terminated. So, otherwise, this means you will treat this 10% deposit as a liability, which is quite normal. But there could be situation like you have the advance, but the contract is terminated and it is not refundable. You can recognize revenue regardless whether it satisfies the rest of the IFRS 15 criteria or not. Do we have any question, please?
Yes, there are lots of questions, but yes, Zan is asking for an example of your last concept. Will you explain it?
I just gave the example. Yes, I just gave. Okay, I'll give another example. In the last example, I said the customer to whom company sold a building for 1 million, that customer paid 50,000. So because contract is not terminated, there are remaining obligations. Substantially all consideration has not been received. So that 50,000 will be recognized as a liability. So that is another example. Yes. Do we have any question?
Lots of them. They can type in their questions if there are any more, but let me begin with these questions one by one.
Yes, please.
The first one is, okay, Hafiz Asad is asking, I think IFRS 15 application is further delayed until 1st January 2018. Please confirm.
So far, because so far it is not delayed. It is applicable from, this may vary from country to country, but so far it is not delayed. This may be the case maybe in any particular country, but on a global basis, this will be applicable from 1st January 2017.
Okay. And then another question which is similar, but I'm going to skip that. How do we calculate expectations? This is Muhammad Ismail.
Expected revenue. Mr. Ismail, we will be learning it in step number 3, of course. So just please give me the question which are related to the step number 1. In step number 1, we just discussed what should be there in order to treat that transaction as a contract. Because contract can be verbal, contract can be written. It should be enforceable in law. It is probable that the money will be received. Both parties know their respective rights, what will be received, how much will be paid. So all these things should be there and it should be enforceable in law. So if anybody has any question related to step number 1, then I'll be answering at this point in time. Otherwise,
there are other varied questions also. For example, there's a difference. What's the difference between IAS 18 and IFRS 15?
As I said, we have the agenda to discuss it at the end of this presentation, because our main focus is to expand on IFRS 15.
Okay. Zishan Aslam is asking whether the contract should be in written form.
Yes, it could be or it could not be. It could be written or it could be verbal. Both are allowed. Like I gave the example, like you go to the grocery store. So there is no written contract. So it is implied. So that grocery store will be recognizing the revenue because it is allowed.
Yeah. Zain Ahmed Siddiqui is asking on what basis will we be allocating the prices?
Yes, we'll be discussing in next steps.
Okay. What if the service is offered free after delivery of a product? Does some amount of revenue need to be allocated to the free service as well? This is Faisal Siddiqui.
I'll just tell one thing, though we will be discussing it in step number 3. So there is no concept of free lunch. So I think I should move further because people started asking questions related to the next steps.
Okay.
So this means step number 1 is clear. Only we received 2 questions.
No, but there's so many questions.
Okay, fine. You can scrutinize them.
Okay.
And if anything related to the step number 1, once I'll discuss few more steps, we can come back. No problem. So let's move further. So this was the step number 1. One more thing. If a contract does not satisfy criteria for a time being, then you can continuously reassess the contract to determine whether it subsequently meets the criteria. I'll go back to my first example. My first example was a company is selling a building for 1 million. When building was transferred to the customer, at that point, company assesses that revenue should not be recognized because it is not probable that the company will receive the money. But subsequently, maybe after 3 months, 6 months, if it has become probable that the company will receive the money, the company will be recognizing that. This means if for the time being a contract is not satisfying the criteria given in IFRS 15, you should keep on assessing it. And whenever it satisfies the criteria, you should recognize the revenue. So this is the whole story about step number 1. Now step number 2.
There are a lot of questions.
Okay. Step number 2. Let me finish steps. Otherwise, because people are mixing all these steps. So let me finish all these steps so it will be easy to answer.
Okay. After the 5th step, we will take it.
Step 2. Identification of separate performance obligations in the contract. A contract includes promises to transfer goods or services to a customer. Those promises are called performance obligation. Why is identifying the performance obligation important? Because it determines when and to what extent revenue is recognized. This was one of the core principles, performance obligation, promise to deliver goods and services. So, let's expand on this. Here the technical question is there one performance obligation in a contract? Or there are more than one performance obligation in a contract? So you will have to ask 2 questions. Is the good or service capable of being distinct? And is the good or service distinct in the context of the contract? So apparently it seems these are 2 very difficult questions, but when we will understand it with the help of examples, so these 2 questions will become very easy. For example, in first question, the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. For example, I'll give you a very simple example. Like on 1st January 2015, you enters into a contract for a mobile phone with a telecom company on the following terms and conditions. Number 1, you receive a free handset on 1st January 2015 and you pay 2,000 per month. This includes hundreds of free minutes and you are billed on the last day of each month. You can buy the same phone set from the telecom company for 5,000 without the payment plan. You may also enter into the payment plan without the handset, in which case you will have to pay 1,750 per month. This means they are giving a handset. In this plan, you are receiving a handset, free handset, so-called free handset and telecom service. But that handset can be obtained from the same company without this payment plan. And likewise, you can buy the payment plan without that handset. In that case, you will have to pay a lower amount. So this means, if we just ask the first question, is the good or service capable of being distinct? The answer is yes. Because you can separately, it is your choice whether to take it as a package, free mobile set and telecom service, or just the mobile set or just the telecom service. So the answer to the first question as well as to the second question is yes. In this case, is the good or service distinct in the context of the contract? If company does not restrict you from buying either of these two separately, then second question is also being satisfied. So in this case, obtaining mobile set and telecom service are two distinct performance obligations. But if company prohibits you to take it as a package, either you can take it or leave it, mean you will have to take telecom service, you will have to take the mobile. Then second question is not being satisfied. First is being satisfied. Is the good or service capable of being distinct? Yes. Is the good or service distinct in the context of the contract? The answer is no. So in that case, if company will not be selling mobile separately or telecom service separately, you will have to take both these things in a package. You do not have a choice. Then this will be a single performance obligation. So let's see another example. ABC Limited has developed a software package. ABC Limited has entered into a contract with, say, XYZ Limited to supply the following: license to use software, installation service. This may require an upgrade to the computer operating system, but the software package does not need to be customized. Technical support for 3 years, 3 years of updates for softwares. ABC Limited is not the only company able to install the software, and the technical support can also be provided by other companies. The software can function without the updates and technical support. Software was delivered before other goods or services and remains functional without the updates and technical support. It may be concluded that XYZ Limited can benefit from each of the goods and services either on their own or together with the other goods and services that are readily available. The promises to transfer each good and service to the customer are separately identifiable. In particular, the installation service does not significantly modify the software itself, and as such, the software and the installation service are separate outputs promised by ABC company rather than inputs used to produce a combined output. In conclusion, the goods and services are distinct and amount to 4 performance obligations in the contract under IFRS 15. Number 1, license to use software is a separate performance obligation. Installation service is a separate performance obligation. Why? Because this software does not require significant customization. Or further, installation can be provided by any company, not only by the company who has provided this software. So, installation service is a separate performance obligation. Third, technical support for the 3 years. which can be provided by any company, and 3 years of updates for software, because software can work without these updates. So these updates are again a separate performance obligation. So this means, coming back to these two questions, so this means you need to answer these two questions. Sometimes answer to question number one. Question number one, this is the good or service capable of being distinct? So the answer to this question is yes, sometime. But because those goods and services are not distinct, when it is not distinct, then mobile company says you will have to buy both things as a package. You cannot segregate it. You cannot buy one and leave other. So this means question number 2 is not being satisfied. In that case, that will be a single performance obligation. Here in this case, if installation involves significant customization, then license to use software and the installation service, both will be treated as one performance obligations. Similarly, series of distinct services that are substantially the same have same pattern of transfer to the customer. That contract can be treated as a single performance obligation. For example, an entity enters into a contract with a customer to provide a weekly service to clean a customer's offices for 1 year. The contract is signed on 1st Jan 2001 and work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services that are substantially the same, meaning cleaning their offices weekly. So, though distinct, each week is distinct, but services are substantially the same, then in this case, you can recognize it as a single performance obligation. So this will be the single performance obligation. So this was the step number 2. What we learned from step number 2, that the important thing is to identify how many performance obligations are there in the contract. There could be 1, there could be 2. But how will you decide? On the base of these 2 questions which are appearing on these slides. No, let's move to the step number 3. Step number 3 is determine the transaction price. Apparently, it seems very simple, but in fact, it is one of the complex steps in certain situations. So, transaction price, of course, the amount of consideration that an entity expects to be entitled. 2. Excludes amounts collected on behalf of a third party for example, government taxes, for example, sales taxes, VAT, and things like this. So these are basically the collection which you do on behalf of third parties. That will not become, as we all know, that will not become the part of the revenue. Price of the performance obligation or the goods or services were delivered. But what about when there are variable consideration, variable or contingent consideration? How to account for those? How much we need to include as a revenue and how much we need to exclude? Especially in case of this variable or contingent consideration. Standard says you will have to calculate either, let me use the pointer so that I could better highlight that. I think this is highlighted. Okay, so standard says that you can either use expected value for the calculation of variable or contingent consideration, or you can use the most likely amount. First of all, we understand what is variable consideration. Variable consideration can include discounts, rebates, refunds, price concessions, credits and penalties. So these are the variable considerations. So the next question is when we will use expected value. And when we will use most likely amount, we will use expected value if this is basically the sum of the probability weighted amounts in a range of possible consideration amounts. And this may be appropriate estimate of the amount of variable consideration for a large number of contracts with similar characteristics. I'll repeat, expected value may be appropriate estimate of the amount of variable consideration for a large number of contracts with similar characteristics. And now let's see the most likely outcome. This may be appropriate if the contract has only two possible outcomes. For example, an entity either achieves a performance bonus or not. So if we just make it very simple, expected value where there are a large number of possible outcomes. Then you will calculate the expected value and will use it as a revenue for the recognition of the revenue. But if there are only two outcomes, then you will be using the most likely outcome out of those two amounts. So this is the variable consideration. So next is let me explain variable consideration with the help of a few more examples. See, an entity enters. So this is very important. Now we are entering into an area where I need your more attention. So I may take a small break, though we decided that we will be taking the question at the end. But I just before venturing into a complex area, I want if there are any question related to step number 1 and step number 2. Of course, I would not be answering any question related to the other steps, only related to the step number 1 and step number 2.
But you can always say skip. I mean,
okay.
That way people who asked the question will also know that their question has been skipped for later definition, right?
Okay.
Okay, there are too many questions, so probably it'll take about 15 minutes. I'll be very, very quick.
No problem.
Okay, the first question that I'm going to now ask is from Mohammed Bakir. It says, the same also happens in construction contracts where you recognize revenue on condition of contract/work done. Will it still be applicable since IFRS 15 has made it clear now? You want me to repeat the question?
No, no need to repeat the question. In some situations, yes, but after completing 5 steps, he will be knowing where it is not yes. Before it was yes. 11, as per IAS 11, it is yes, but according to 15, in most of the situation, the answer is yes.
The next question is Shafaq Jamil. Allocation of price means divide the price into 2 products according to performance obligations?
Yes.
Okay. A lot of people asking will this slide be shared? Yes, they will be shared.
Yes, they will.
Then the next question is from Svetlana. I'm sure from Sri Lanka. I can't pronounce the name properly. What we could do before 2017? Deal with full amount only without allocation between POs?
No, because this will be applied retrospectively. So any outstanding contracts will have to be accounted for according to IFRS 15.
Okay.
Though this will be applicable from 17, but any outstanding contracts in 2017 which belongs to 2016 or 15, opening balances will have to be restated. Yes.
Okay. Muhammad Arif Javed says, what is meant by implied contract?
Like in case of you go to the grocery item, so this is employed that you want to buy and the other person want to sell.
Okay. Tamar Hassan is asking if contract can be cancelled without penalty, then how about the verbal contracts? I think there are too many questions about verbal contract. If you can explain them in one go.
Okay. Yeah. See, I mentioned about the verbal contracts in the context of the grocery store. This is number 1. When you go to the grocery store, you put your shopping bag in front of like cashier. So you want to pay. So at that point in time, but when you are standing in front of the shelf and you take something and you have to put it back, so that is not the point where like this condition is being met. Verbal contract is like there is a tradition like people people regularly buy and sell from each other. So when you receive something, there is no anything in writing. You receive something, so standards say this will be considered as a contract provided all the condition that it is probable you will receive the money. This delivery of goods, this satisfaction of performance obligation is enforceable in law. So if all conditions are being met, whether written or verbal, that will be a contract.
All right. It's Svetlana again, and my apologies if I'm not pronouncing your name right. The question is, could you please provide a short summary of before and after? Thanks.
Before and after?
Yeah, of IFRS 18 implementation, I think. 15 implementation.
15 implementation. I think, can you
elaborate the question?
Yes, please.
I think you can you rewrite the question because your question is not clear? We can go on to the next question in the meanwhile. So Laman Sheikh is asking, is saying, no sir, no revenue should be recognized. I think this was regarding an example being given. We'll skip the question. We'll move on to the next one. Okay. What about transfer of risk associated with goods? This is Jawad Ahmed.
Risk associated with goods?
Yeah.
What kind of risk?
Jawad, you also need to explain your question.
Actually, now they started asking questions which will be automatically answered. Actually, Mr. Jawad is saying that if like there is a warranty or guarantee or something like this, under which you goods can be returned. If goods can be returned, so how can you recognize the revenue? So this will be addressed in the coming steps.
All right. Okay. In your real estate example, what if the customer puts some financial or non-financial guarantees to the real estate owner? In that case, can it recognize the revenue? This is Mr.
Yes.
Amarlal.
Yes.
Okay. Next question is Sabika Ansari. If the building is transferred and it's not probable that the consideration will be collected and ultimately it's not collected, how will the loss be recognized in books and under which IAS?
Yes. See, when you transfer the building, if customer is unable to pay or it is expected that he will not be paying, you cannot recognize revenue. But you will be making an entry, which we will be discussing in the coming steps. That entry will be reversed. Building will be re-recognized in your financial statements as a like current assets if you are a real estate developer.
Okay. Umar Abdul Wajid is asking, under which standard will the revenue be recognized for this sale of building? Same question.
For the sale of building, if you're a real estate developer, you develop like buildings, houses. So this is your inventory. So under IFRS 15, you will be recognizing because right at the start, I told IFRS IAS 11, IAS 18 are replaced with IFRS 15.
Okay. Next. There's still too many questions. I mean, probably be. I mean, there are more coming also.
Okay. Yes, please.
I think we can. We need to answer some questions.
Yes. Okay.
No. Should we continue answering some questions because otherwise
actually,
people will not be.
I felt perhaps they started asking questions which relates to.
There are a few individuals
which could be automatically answered maybe in the coming steps. Even if those are not answered, so we'll be taking up with reference to these steps. Right now we are just on step number 3 and we have not yet finished step number 3. Step number 3 is a little complex. Okay. Let me come back to step number 3.
Okay. But there are too many questions in the pipeline.
Step number 3. I'll try that once I finish 5 steps. So I'll invite your question and I'll try to answer because I hope that after going through all these steps, maybe a lot of questions are automatically answered. See, step number 3. Step number 3 we were discussing if there is a variable consideration. So let's take an example. An entity enters into a contract with a customer to build an asset for $1 million. In addition, the terms of the contract include a penalty of $100,000 if the construction is not completed within the 3 months of a date specified in the contract. The entity concludes that the consideration promised in the contract includes a fixed amount of 900,000 and a variable amount of 100,000. This is the concept of the variable amount. So 100,000 variable, 900,000 fixed. Now, should we recognize 100,000? The answer is either you will have to see the expected value if there are a large number of similar contracts, or most likely amount. If there are just two outcomes, you can recognize revenue on the basis of most likely amount. See, let's have another example. And okay, so let me make it off so that I can move further. Yeah. So this is variable consideration or contingent consideration. Second is non-cash consideration. Only one point related to the non-cash consideration. For example, I'll be explaining it with the help of example. An entity enters into a contract with a customer to provide a weekly service to clean offices for 1 year. The contract is signed on 1st January 2001 and work begins immediately. In exchange for the service, the customer promises 100 shares of its common stock per week of service. In exchange for the service, the customer promises 100 shares of its common stock per week of the service. So, how the revenue will be recognized? At the end of the week, you will be recognizing revenue equal to the fair value of those 100 shares. Once revenue is recognized, subsequently there may be changes in the fair value of those shares. So that will not affect the initially recognized revenue. So this is about non-cash consideration. Mean, when the performance obligation is satisfied, you will be recognizing the revenue on the base of the fair value of that consideration. Once that revenue is recognized, subsequently there may be change in the fair value of that particular item. In the example which I just gave, in that case, shares. So that change in the value of the shares will not affect the initially recognized revenue. This is non-cash consideration. Then is consideration payable to customers. Consideration payable to customers. So this is also interesting. Like for example, you have had a contract. An entity that manufactures, say, consumer goods enters into a 1-year contract to sell goods to a customer that is a large global chain of retail stores. The customer commits to buy at least 15 million of products during the year. The contract also requires the entity to make a non-refundable payment of 1.5 million to the customer at the inception of the contract. The $1.5 million payment will compensate the customer for the changes it needs to make to its shelving and to accommodate the entity products. The entity concludes that the payment to the customer is not in exchange for a distinct good or service that transfers to the entity. This is because the entity does not obtain the control of any rights to the customer shelves. Consequently, the entity determines that in accordance with 15, the 1.5 million payment is a reduction of the transaction price. So let me take the help of pen. See, you entered into a contract for the provision of goods worth 15 million. But that contract includes a term that you will have to pay 1.5 million to the customer. You will have to pay, see, consideration payable to the customer. You will have to pay 1.5 million to the customer to amend its infrastructure so that it could place your goods. So standard says this 1.5 million is not your asset because you do not control or own these shelves. So as a result, you will be recognizing revenue 13.5 million instead of 15 million because you deducted from this amount consideration payable to the customer. So this concept relates to the consideration payable to the customer. So now come to a very important concept which will answer a question someone asked earlier in which he says, what will be the loss to the company? So that question will be automatically answered if we understand another example. See, an entity enters into a contract with a customer for the provision of 100 items. And the price of each item, so let me use Word so that I could write for you the relevant figures so that you could understand what I mean to say. I think there is some problem. It's not showing the bar. Okay, we'll use this. Okay, so let's raise the first material. Then we'll be okay. In order to save time, we can move to the next page. Okay. Pen thickness, contract for delivery of 100 items. 100 items. Price charged. So I would recommend if you have pen and notebook, you just write with me because when I'll move down, so you may not be able to see what I wrote at the top of this page. Price charged is equal to $100 per item. $100 per item. And the cost to the company of manufacturing this item is, say, $60 per item. $60 per item. You deliver the goods, but there is a term in the agreement that says customer can return some of the goods under that term. Like if he's not happy, if that item is not up to the mark, the customer can return that item. Because the contract allows the customer to return the products, the consideration received from the customer is variable. I'll repeat, because the contract allows a customer to return the products, the consideration received from the customer is variable. To estimate the variable consideration to which the entity will be entitled, the entity decides to use the expected value method because it is the method that the entity expects to better predict the amount of consideration to which it will be entitled. Using the expected value method, the entity estimates that 97 items or products will not be returned. Will not be returned. Will not be returned. So when you estimated that 3 items may be returned, so what entry you will make? So the entry will be, hopefully this should explain a lot of things. See, you have received the cash. We are assuming you have received the cash. So cash will be debit. Cash will be debit. How much you have received? You have received rupees 100 into 100 items which you supplied. 100 items. This means you received $10,000. Now, revenue will be credited with the expected consideration. Someone asked right at the start, what is the expected consideration? So expected consideration is 97 units into $100. Mean 9700 is expected consideration. And what about the rest of the amount? That will become refund liability. Refund liability 300. So this will be the entry for revenue. So at this point in time, I hope this should be clear. So if you just want to see it again, because this is very important, this is something very practical in terms that you can use this concept to make your entries if your situation is similar. We have a contract to supply 100 items and price of each item $100 and cost to us is $60 per item. So because there was a term in the contract that the customer can return as a result of whatever reason, because of warranty or because of damage or whatever reason. So we concluded that though we have received 10,000 when we transferred these 100 items, but revenue is variable, consideration is variable. We may not be entitled to the 10,000. So this is variable consideration case, and we decided, okay, we will use expected value method to calculate how much at the end of the day we will receive. So we concluded that, keeping in view the past history, that 3 items will be returned, so we will receive at least 97. Customer will return 3 items. This means we will receive the revenue equal to the 97 items. So the entry will be cash as we received, but credit to the revenue equal to the expected consideration, 9,700. And remaining amount will be refund liability. So I just want to highlight one more point. While determining what is the expected consideration, one thing is important. Like if you go back to this, hopefully this should help to go back to the slides so that you could see the slides. If we go back to the slide, I hope we can, yes, complete. Yes. So here the important thing is, whatever you value calculate, it should be highly probable that a subsequent change in the estimated variable consideration will not result in a significant revenue reversal. Here we have recognized 9700. So if there are any changes in our estimate, so there should not be a significant change in this 9700. So this is the criteria. So this is the entry for the revenue. Now what about the cost? For cost the entry will be, we will debit cost of sale and credit stock. Our cost is $60. 100 items were out, so stock will be credited with 6,000. Debit cost of sale. Cost of sale will be for those items for which we recognized the revenue. And the balancing figure will go to the asset. Which asset? Right to receive the returned goods. Right to receive the returned goods, which are 3 items into 60. So this will be debited with 180 and cost of sale will be with 57. I hope this calculation is correct. Mr. Haroon, can you help me? 97 into 60, it should come to 5720. Let me take the help of the calculator. So this is 97 into 97 into 60. So this comes to 58. Yes, there is a small calculation mistake. So this should be 5820. So this is the entry for the cost. See, if goods are returned, we assume that 3 goods were returned. So what will happen? Stock will be debit and this asset, let me change the color. Okay, let's use this color for the same thickness. If 3 goods are returned, so what will happen? Stock will be debit with 180 and this asset will be credited. This will be reversed. Similarly, if you have sold a building, I'll be back to that point. If you have sold a building for 1 million and you are not recognizing revenue because it is not probable that you will receive the money. So this means first entry is not there. There is no entry related to the revenue. Yes, you received 50,000, but the entry for that will be debit cash, credit liability, because that is advance. Because criteria for the contract is not being met. So that is advance. You will be recognizing it separately. Subsequently, if customer is unable to pay as you expected, that's why you did not recognize the revenue. But at the same time, you will be making the entry like when you transferred the building. Stock, because building is your stock credit, and debit the right to return. The same asset which name can be different, but this will be an asset right to receive the building back. Something like this. You will create an asset with how much amount? Cost of that building. Similarly, here cost of that building. You know, debit and credit will be the same. Cost of that building. If you have to receive the building back, if customer vacate the building, so what will happen? Simply this entry will reverse. Simply this entry will reverse. You will get your stock back. There is another question, like if it's net realizable value or cost, that is related to the international accounting standard too. If once you receive this building and you found that it should be like its net realizable value is lower than the cost, then of course this should be treated under ISA 2. So this is related to the variable consideration. So let's move next. So let's go back to the presentation. So okay, let me go back to the presentation from here. I think yes. So it is not working, I think. What happened? I think it's happened. Should work. Okay, it should work, but anyway, it is not working. So let me.
What write on the slide?
Can't. I can't. Before I can, but right now I cannot. I want just to that it should move from here. Okay. So it is already normal non-drying mode. Let's try again. It's not working. So
Strange.
So there is a technical problem. Just bear with us for a while. Let me.
Way too many questions. Break. Is this a break?
Okay, we can take a break.
Yeah.
We can resume or not?
We can take a break if you want.
No, I want to complete with the 5 step.
Okay. Right. So is your pointer still not working?
Because it is not showing.
ड्राइंग टूल्स में से कोई और टूल उठा लेते हैं for now.
Can I control plus R delete? Can I do?
Restart the system?
No, I'm not restarting. I just want to go to the task manager. Let's see, because it is not accepting.
Move to exit.
Who's that? Telecasting?
Is this the one we're using?
Yes. Okay.
No
problem. Word access करने
we have asking.
We should take.
Announce a break and we'll come back.
And restart the system. So there is some technical problem, so we can take a break by the time this will be solved. So let's have a 15 minutes break. Thank you. Direction is in.